How do you take something as massive and complicated as the gap between the rich and the poor and boil it all down to just one single number? Well, that's exactly the challenge we're tackling today with a powerful little tool called the Gini Coefficient.
I mean, really think about it for a second. How do you put a number on fairness? It sounds kind of impossible, right? But that is precisely the problem the Gini coefficient was created to solve. So, to really get why this one number became such a big deal, we need to rewind a bit, back to a time when the inequality puzzle was becoming impossible to ignore.
The Industrial Revolution turned out incredible wealth, but it also created these huge, glaring gaps between the ultra-rich and the very poor. And it got to a point where just looking around and saying, wow, some people have a lot and some have very little, just wasn't enough. People needed a real scientific tool to measure just how big that gap was actually getting. And this is where our main character enters the scene, an Italian statistician named Corrado Gini, who came up with a truly elegant solution that all starts with a simple drawing. So, what was Gini's big idea? Well, it doesn't start with some crazy formula. Nope, it starts with a picture. It's called the Lorenz Curve, and it's a surprisingly simple way to visualize how all the money in a country is actually divvied up. Okay, let's build this thing together, step by step. First, picture a graph. Along the bottom, you line up every single person in a country, from poorest to richest. And up the side, you track the total share of income. Now, if everything were perfectly equal, a total fantasy world, right? The graph would be a perfectly straight diagonal line. The poorest 20% of people would have exactly 20% of the money. But in the real world, well, the actual distribution is a curve that sags way below that perfect line. That sag shows you that the poorest slice of the population holds a much, much smaller slice of the pie. And here is the magic trick. The Gini coefficient is simply a measure of that gap. That's it. It's a number that tells you how much that real-world curve sags away from the line of perfect equality. The bigger the gap, the bigger the Gini number, and the more unequal that society is. So simple, so elegant. The whole thing works on a super simple scale, 0 to 1. A Gini of 0? That's your utopia of perfect equality. The Lorenz curve would be that perfectly straight line. A Gini of 1? That's the other extreme, perfect inequality. A world where one person has literally everything and everyone else has absolutely nothing. Every single country on Earth falls somewhere between those two poles. Okay, but here's where it gets a lot more nuanced, because that one little number can tell completely different stories depending on what you decide to measure. See, we can measure income inequality, that's the money people are earning from their jobs year to year, or we can measure wealth inequality, that's the total stock of assets people own, houses, stocks, the whole shebang. And whoa, the difference can be massive. A country might have a kinda okay income Gini, let's say 0.35. But then you look at its wealth Gini, and it could be a whopping 0.70. That tells you that even if paychecks are spread out a bit, the actual ownership of stuff is way, way more concentrated at the top. And you can see this playing out all over the globe. The Nordic countries, famous for their strong social safety nets, tend to have lower Gini values, hovering around 0.28. Then you have the United States, which sits quite a bit higher, near 0.48. And many nations in Latin America can have Gini values well over 0.50. This single number is what lets us make those powerful at-a-glance comparisons. But for all its power, the Gini isn't perfect, not by a long shot. I like to think of it as a flawed masterpiece. It has some incredible strengths, for sure, but also some pretty serious blind spots. So what makes it a masterpiece? Well, for starters, it's beautiful simplicity. It's one number, right? Easy to grasp. It lets you compare a giant economy like China with a tiny one like Sweden on the same terms. Plus, it takes the entire population into account, not just the richest and poorest. It's become the gold standard for a reason. It's used by everyone from the World Bank to the OECD. But, and this is a big but, here are the flaws. Two very different countries can end up with the exact same Gini number. It doesn't tell you how a society is unequal. Is the middle class getting squeezed? Are the rich just running away with it? The Gini won't tell you. It's also just a snapshot in time. And maybe most importantly, a country could have a great Gini score, but everybody is equally poor. The number only measures the gap, not how well off anyone actually is. And that's exactly why, to really get the full picture, you have to look beyond just this one number. And thankfully, we've got other tools in the toolbox. The Palmer ratio, for instance, zooms right in on the extremes, comparing what the richest 10% have versus the poorest 40%. The Thiel index lets you do something really cool that the Gini can't. You can break down inequality within different groups, like between urban and rural areas. These don't replace the Gini, but they add these crucial layers of detail to the story. Which really brings us to the most important point of all. These economic numbers, they're just one piece of a much, much bigger puzzle. True inequality is about so much more than money. It's about having access to good schools, quality healthcare, and just the basic opportunity to build a better life.
In the end, the Gini coefficient is a brilliant tool. It's an amazing conversation starter. It gives us a common language to talk about one of the biggest challenges we face. But that's what it is, a start. The full story is always so much messier, so much more human. So I'll just leave you with this question to think about. What does the full story of inequality look like to you?